Good morning, this is Nick Stern with Robert L. Stern Financial Services. I'm a certified financial planner here in Amherst, Massachusetts. Taking advantage of a really nice day at the end of February. As you can see, I'm making a bold fashion statement by wearing a flower tie and a pink shirt and flower cufflinks at the end of February, and it's still winter. So I'm owning it. I love the warm weather. I can't wait for the spring and summer. Anyway, what I wanted to get into for this month of February is it's tax time. I'm sure everybody is extremely excited about it, and they can't wait to pay and file their taxes. That's a joke. But what I wanted to discuss, and again, thanks for tuning in, are just maybe some reminders, considerations when you're going through and filing your taxes. A disclosure, I am not an attorney. I am not a tax preparer. I'm not a CPA. These are just some general themes, general knowledge points, general considerations that I would just remind you to consider and or look into depending upon your current situation, of course, because it always is dependent upon your own unique situation. So anyway, let's jump right in. I think even if you're using a service, an online platform, whatever you may be doing, whether or not it's TurboTax or some other online platform. Not that I'm recommending that, just as an example. I believe they have a 1-800 service, so I would suggest calling that 1-800 service, talking to whatever representative, and just making sure that you're taking advantage of all the tax either credits and or deductions that you have available to you, because it's really not necessary to pay more taxes than you have to. So really, if you've moved, if you've had life events, got married, it's important to look into that, because there can be things that are available to you, even if it's just this year. It's important that you would at least want to know, because if there is something, it could save you some money on taxes, which is always nice. If you're looking and it makes sense for you financially, and again, this is contingent upon your own personal financial situation and your goals and objectives. But let's say you have some cash on the sidelines and you're looking to take an additional deduction from 2016, meaning reducing your taxable income. You may be able to make a traditional individual retirement account contribution, and that would be, for those of you under 50, would be up to $5,500. And over 50, $6,500. However, it's going to be less if you made any IRA contributions already in 2016. You can still do this even though it's 2017, but if you filed your taxes already, then you really can't do it. If you're able to do it or not is going to also depend on whether or not, one, you're eligible for your employer-sponsored retirement plan, a 401k, a simple what have you, and if you are, how much you put away in that. So it's important that you would consult your tax professional or service if that's the case. But just in general, you have that as an option, provided you have not filed your taxes, depending upon your situation. Another thought is, if you're not necessarily looking for a tax deduction, but maybe you're going to make over $130,000 this year as an individual, you might want to consider making a Roth contribution that grows tax-free, taken out tax-free. There's no immediate tax advantage, but as you make more income, you get completely phased out as a single at $130,000, and then as married filing jointly, you get completely phased out at $190,000. So it's just something to consider, something that later on down the line can diversify your retirement income, your long-term savings, so to speak. Because most 401ks or simple plans or other retirement plans are going to be pre-tax, and every time that you're going to take money out from those, presumably at age 59.5 or beyond, that's when the money will get taxed. If you're a self-employed individual and it's only you, or if you have employees and you're willing to make the same amount of contribution that you would for yourself to the employee's account, you could look into doing a SEP IRA. I would just double check that you're eligible to open up a SEP IRA if you haven't already. But if you have a SEP IRA, you can still make a SEP IRA contribution. How much will be dependent upon your income, and that's something that your tax professional or service can calculate for you. And again, it depends on your situation, but just in general, this is something that you may have available to you. A couple things. Maybe you recently got married, or you're thinking, well, does it still make sense for me to file your taxes married filing jointly? In most cases, yes. There are some cases where it would make sense to file separately. In general, it's when, preferably, of course, the lower income earner has significant itemized deductions. Usually in these cases, the itemized deductions are medical expenses for the year that you're filing taxes that exceed 10% of your adjusted gross income, or AGI. There are some other circumstances where it could make sense, but in general, unless there's significant itemized deductions where it would make sense, and you're only going to know if it's going to make sense if you run the numbers or run rough numbers. But in most cases, you're going to get a better tax advantage from filing jointly rather than separately. Also, when you file separately, you stand to potentially lose some deductions that are meaningful for when you file jointly. One of which could be the deduction of IRA contributions, Roth IRA contribution eligibility, higher education deductions, some child care or adoption credits, just to name a few. So those are some where, again, you'd have to run the numbers to make sure it makes sense one way or another. So overall, the real takeaway, I would say, is it's important that you look at all your options and have a really good understanding, because even if you're saving a couple $100, that means a couple $100 more in your pocket to something fun, to something else. And I'm not saying that you should be aggressive when you file your taxes. I'm saying that, or recommending that, you should have a really good understanding of what's available to you. And if you're just kind of brushing through it since you're doing it on your own, it's important if you do that, and it's fine if you do, but it's important if you do that, that you're really taking the time to do it and making sure that everything you have available, you're able to take advantage of. So that being said, thanks for tuning in. Really appreciate it. If you have any questions, feel free to call. Number, email, totally here for you, no obligation. I hope everybody has a great rest of February, and I look forward to seeing you in spring, I think. I don't know if the end of March is spring or not, but anyway, I'll see you then. Have a nice day.